Hey guys, welcome back to the VIP channel. Want to talk about one of my favorite subjects here with you all today while I'm driving, getting a lot of work done here in Florida over the summer, and want to talk with you about one of my favorite debt weapon loan tools called a home equity line of credit. You're probably familiar. Now, I've credited home equity lines of credit for the past several years for literally providing me with a completely financially independent lifestyle. I'm able to go where I want, when I want. I can do what I want. I don't have to worry about price tags. And I can do that remotely by having simply used a home equity line of credit to make great investments that have paid off, and it supports my lifestyle choices. Now, if you've been contemplating utilizing your home equity, this actually could be the right time to do that. Over the last decade, we all know that home prices, home values across the United States have consistently risen, and it's left a lot of homeowners with substantial equity in their properties. However, it might not be the case for much longer. According to a recent survey that Zillow did, economists and housing experts have anticipated now a 1.6% decline in housing prices through 2023. So with this in mind, it might be wise to consider your home equity now before your home values decrease. So why should you use your home equity before home prices drop? Well, lenders are usually going to allow borrowers to access 80 to 85% of that home equity. So the lower the value, the less you might have access to. In order to determine what your home equity is, what you need to do is subtract the outstanding balance of your mortgage from the current market value of your property. For instance, let's say that the original mortgage balance was $400,000 and you've made $100,000 worth of mortgage payments and you've reduced the balance to $300,000. If your home's current market value is $500,000, then your home equity is now $200,000. However, when home prices drop, your equity also reduces and it makes it less accessible to you. Therefore, if you're considering a home equity loan or HELOC, it's better to take advantage of your equity before your home values decrease, and that allows you then to access a higher amount of equity. So if now is the right time to unlock your home's equity, what you need to do is look at getting a home equity loan or a home equity line of credit. What's the difference? Well, a home equity line of credit or a HELOC is generally more beneficial because investors can then use that money, pay it back, use it again, and pay it back. So I would prefer that over a home equity loan, and that's the one that I would recommend 99 out of 100 times. And the primary difference really between the two is that the home equity loan provides a lump sum of money up front, meaning you're paying interest right away, while the HELOC works more like a credit card, and it can provide you more of that discretionary utilization where you're only using it if you find a great opportunity to do so. HELOCs provide more flexibility in accessing funds and then enables investors to borrow only what they need when they need it. HELOCs also have lower interest rates than home equity loans, making them more cost effective, but HELOCs work with a variable interest rate. So that interest rate is going to go up or down according to what the rates are doing. But you only pay the interest on the amount that's borrowed. Whereas with a home equity loan, it does require you to pay the interest on the entire loan amount, even if you don't need all the money up front and it sits idly in the bank. Furthermore, HELOCs offer an ongoing source of credit, and that can be used repeatedly as needed. And it makes it more efficient, therefore, for investors who need to access funds regularly or just temporarily, and then you can rapidly pay that back to avoid much of the interest costs. So you can use the HELOC to fund investments, and then you can pay it back as they receive returns, or as you receive returns, and then you can borrow it again as needed. Now, overall, HELOCs are a much more versatile and cost-effective option for investors who need access to capital frequently, and it will provide more flexibility, lower interest, and it allows you to borrow only what you need when you need it. So now that we've identified HELOCs really as being the better option almost all the time, what are the best HELOCs that are out there right now? The 5 best HELOCs, in my opinion, that you need to be taking a closer look at include those from Bank of America, Bethpage, Guaranteed Rate, PenFed, and PNC Bank. Now, let's quickly dive into some key details for each. Okay, so Bank of America HELOC is rated by Business Insider as their best overall option due to the 85% max combined loan to value. And with the lack of fees and the ease of availability in all 50 states, it's really going to top the list. Bethpage being the second, which is a federal credit union Their HELOC also has an 85% max CLTV. It's available nationally. It also has a minimum credit score requirement of just 670. Additionally, Bethpage has a perfect 5-star rating on NerdWallet, which we trust. They're a friend of the channel. So it definitely is a solid option to look at. Guaranteed Rate is another nationally available option. It also has an 85% max CLTV, but it does have a lower minimum credit score requirement at just 620. So if you don't have perfect credit, that might be a great place to explore. PenFed Credit Union, I've been talking about them for years. They remain a fantastic option with a max LTV of 85% and a nationwide availability. And lastly, PNC Bank has a 5-star rating with NerdWallet as well, and they offer an 80% max LTV to those with a minimum credit score of 680 or better. So as you can see, these 5 solid options carry more similarities than differences, and this is something that you'll find when researching HELOCs on your own. The last home equity line of credit I got cost me no money out of pocket, and with just a $150 annual fee, it's extremely affordable to keep open even if I'm not using it, and that fee is even negated if I have an interest cost that exceeds that amount. But here's the thing, it's crucial to get beyond the basics when you're shopping around for home equity lines of credit. Not just so that you can get the best possible product for your needs, but so that you can avoid hurting your credit scores in the process. It's not wise to go out and apply for several of these all at once, as each is going to likely hit what they call inquiry or trigger on your credit, and each of those will reflect negatively to your credit. The last application I submitted this week for a debt weapon loan cost me 5 points on my credit scores. And that's why we came up with the debt weapon cheat sheet. It's a free worksheet, and it'll help you cover all of your bases before triggering that inquiry, so you don't get the ding and you can avoid wasting your time and hurting your credit scores in the process. You can find the link to download the debt weapon cheat sheet, no strings attached, in the description below. You actually are going to be able to fill in the blanks on that worksheet with each and every single institution that you reach out to regarding any loan product you're searching for. So this makes it a great way to shop around for any type of debt weapon, including your HELOC, in the future. Curious whether or not you've recently acquired a new HELOC? Who did you go through? Let us know in the comments section below. I've had great luck with banking interactions as of late, so I'm hoping that continues, because it can certainly be a nuisance when you're shopping for a product. And of course, they're going to want every single document from you, and possibly even your firstborn. So just be prepared for that. It is generally irritating interacting and trying to apply for things with banks, but it's worth the effort. The juice is worth the squeeze, as they like to say. And like I said, without a HELOC, I'm not sure I would be anywhere close to where I am right now with my finances. So as long as it's used responsibly, you're using it to purchase and invest in things that provide you income and raise your cash flow, perhaps even consolidating high interest, non-mortgage related debts, maybe using it to apply velocity banking to your existing mortgage, especially with the new interest rates that are applying to new mortgages. Now's the time to revisit the idea of accelerating the elimination of those mortgage balances on a rapid basis. Pay those mortgages off in 5, 6, 7, 8 years instead of 30. And that can literally save you hundreds of thousands of dollars worth of future interest costs. I'll link a video in the description on that as well to show you exactly how that's done. Doesn't cost you any extra money to do it. It's just how you're managing your additional discretionary cash flow in order to accelerate the principal reduction of those loans. Fascinating stuff. And thank you so much to my HELOC and the provider of that HELOC, my bank, in order to allow me to accomplish these goals myself. Look forward to seeing you on the next video. Until then, make sure you hit that like button, subscribe for more, and we'll see you soon. Make it a great day and keep on cash flowing. Take care.